Markets are recovering from that brutal sell-off yesterday. Saw the Nasdaq drop almost 4%. We did get a surprisingly strong growth report for the U.S. economy for Q2. Our guest says that as the S&P trades higher, it is important to rebalance your portfolio. With more on navigating these volatile markets, we're joined by Gary Schlossberg, global strategist at Wells Fargo. Gary, thanks very much.
Thank you for having me.
It looks as though we are. I mean, I know the techs are holding in better today, but we're still seeing a rotation into those smaller companies.
Yeah, it's nothing like a good GDP report to reignite things. We're getting a broadening, moving back into riskier segments of the market, some optimism about the growth outlook, the Fed's ability to engineer that soft landing. And for now, at least, the market's doing quite well.
It's interesting. I mean, you would think that GDP, a strong GDP, would discourage investors because it would delay Fed rate cuts.
Well, I think the market feels that Fed rate cuts are still on the table, still looking at September, not next week's meeting, but with inflation coming down, and we'll get an update on that tomorrow with the June report on that PCE deflator, the Fed's favored inflation measure. But with inflation coming down and growth still holding in pretty well, this is a return to that Goldilocks economy that the market had been hanging on to for so long.
What do you think? Two rate cuts in 2024, that's about as good as it'll get?
That's our thinking at the moment. September rate cut and in all likelihood something in December. A more guarded outlook than the market is anticipating for next year. We do have a growth recovery taking place by the spring of next year. And with inflation turning the corner a bit earlier than normal, we think the Fed will have to move to the sidelines. But for now, at least, multiple rate cuts certainly on the table.
You think it could be a good idea to rebalance your portfolio and, for example, trim technology to a market weighting?
Yes, we're still optimistic on tech's longer-term outlook, but with the run that tech has had, notwithstanding the correction, the setback that they suffered temporarily, we think it's still a good time continuing to focus on quality, large cap, liquid stocks, but broadening out into some of the other sectors of the market. We remain favorable on healthcare, energy, industrials, raw materials for their long-term prospects as well.
Why energy in particular?
We think the supply-demand balance will remain fairly tight, notwithstanding the slowdown that we anticipate here in the U.S. and a very modest recovery globally. Part of that super cycle theme that we think really runs through the entire commodity complex, and we are looking for a slight uptick in oil prices next year. We're also favorable, we're becoming more favorable on financials as well, anticipating some tailwinds for that sector as the economy recovers in 2025.
What about bond investors? Is it safe to go into the bond market now? I mean, obviously bonds are vulnerable, longer bonds, if inflation does come back.
Yes, we, of course, we favor a balanced portfolio, but given the fact that the Federal Reserve will be cutting interest rates, we believe, late this year and into 2025, the short end of the market, shorter-term securities, are an area that we're still favorable on, not the money market area, but shorter-term securities, shorter-term bonds and the like, benefiting from that price appreciation. But staying with quality as well, both in the taxable and tax-exempt sectors.
And you call them certificates of deposit in the U.S. We call them guaranteed investment certificates, fixed-term deposits. You think they're not a great idea right now?
Well, as they roll, if the Fed's cutting interest rates, there is that opportunity cost matched against the price appreciation in securities, even the shorter-term securities. We think the shorter-term securities look more attractive.
Just going back to the tech equities, what do you think deflated some of the euphoria over the past week or so?
Well, some concern about translating the promise of AI, artificial intelligence, into some near-term earnings gains. I mean, the market has, that segment of the market has had a tremendous run. Valuations are not extreme necessarily, given the longer-term outlook, but investors were looking for the shorter-term payback. And after the tremendous rally they've experienced, there was some concern about their near-term prospects at a time when the economic outlook was becoming a bit more favorable for the U.S., encouraging a movement to other segments of the market.
Yeah, because if people expect a big payoff from AI in the very near term, presumably they will be disappointed.
We would think so. This is a fairly typical pattern. A lot of euphoria as a new innovation is incorporated into the economy, a more sober outlook for a period. And then as the gains, the promise of that new technology is experienced, then you see the more enduring gains in the market. We're seeing something of that. AI is certainly unique, but certainly something like that, we believe, this time around.
Have you had occasion, have you come across it in your business, or have you had occasion to use it yet?
Not quite yet. I'm an older guy and still 20th century, as my daughter likes to say. But I know people around me, especially the younger people, are incorporating it increasingly. And I better get on the bus as well. Otherwise, I might miss out on some real opportunities professionally.